Hey, what's going on, guys? Ron Sneller here. Welcome to another edition of 3 for Thursday. So, listen, guys, the Federal Reserve, by switching from a scarce reserve model to an abundant reserve model, has completely taken over the short term interest rate marketplace. What this means is that the markets are not necessarily focused on economic data itself, but are trying to figure out what Jerome Powell and the Fed think about the data and what the Fed is going to do. So, in this week's edition of 3 for Thursday, we're going to look at the dramatic changes experienced across markets in the US and overseas as expectations evolve about what the Fed and other central banks will do. There's a lot of uncertainty, and these shifting perspectives about policy changes have led to some severe market volatility recently here. So, for a more detailed analysis, we're going to refer to three very important charts that we've prepared for you here today. Now, before we jump into that and get rolling, I'd like to thank our friends over at First Trust Advisors LP for putting this information together for us to share with you. For more information, I highly recommend that you follow them. Go follow Brian S. Westbury, Chief Economist at First Trust, and Robert Stein, Deputy Chief Economist at First Trust. These two gentlemen are a wealth of information, and I think you'll get a lot out of following them and learning from their knowledge. Now, guys, let's get into this. We got the first chart on our screen right now. The CME FedWatch tool is a widely utilized resource that offers insights into market expectations for changes in U.S. monetary policy, particularly regarding the Fed's target interest rate. This tool calculates the probability of the FOMC, or the Federal Open Market Committee, the probability of rate changes for upcoming meetings by analyzing pricing data from 30-day Fed funds futures contracts traded on the Chicago Mercantile Exchange. That's the CME, the Chicago Mercantile Exchange. Now, last Monday, the market was anticipating 3 rate cuts totaling 75 basis points by the end of the year. However, the market now expects, there's been this shift, the market now expects 3 rate cuts totaling 100 basis points, starting with a larger than normal 50-point cut at the Fed's next meeting in September. On to chart number 2 about the U.S. Treasury yield curve. Now, throughout this year, guys, we've emphasized the importance of extending the duration of your bond holdings, meaning to lengthen the average maturity. And a common question that people ask is, why would we do that when cash yields over 5% are readily available? Why not wait until short-term yields start to decline? Now, the key reason is that yields, especially in the current artificial environment influenced by the Fed, can change rapidly. For example, as recession fears resurfaced late last week, the yield curve shifted significantly. The 2-year Treasury yield dropped by 35 basis points since last Monday, while the 5-year and the 10-year Treasury yields fell by 25 bips and 18 bips, respectively. Now, on to our third and final chart, and this one here is a little bit scary, guys. You see, there's been a significant dislocation that's occurred in what's called the Japanese yen carry trade. This is a popular strategy that involves investors borrowing Japanese yen at Japan's low interest rates and then investing those funds into higher yielding assets or currencies. Now, profits are generated how? Well, from the difference between the low interest on the yen loans and the higher returns from the investments. However, this strategy is unraveling as the Bank of Japan is continuing to raise rates while the US appears poised to start cutting rates. So lower yields in the US bond market combined with higher short-term rates in Japan and a 5% appreciation of the yen since just last Monday has triggered widespread margin calls. This has forced the unwinding of these carry trades, exerting additional upward pressure on the yen, which in turn will likely lead to further margin calls, which will likely lead to further volatility and perhaps even a stock market crash. Who knows, right? I mean, at this point, it's really anybody's guess, but there's just so much uncertainty and so much volatility in the markets right now. So, guys, let me wrap up by saying this. If this is something that's concerning to you, and if you would like professional assistance with the management of your portfolio or your retirement income planning during these trying times, you can connect with us through our website at snellerfinancial.com or through any of our social media channels where you may be watching this video. I'm Ron Sneller, registered financial consultant and investment advisor representative. I've been in this business more than 10 years and have happy clients in 47 states and in Washington, D.C., and even in the Virgin Islands. Book a free consult to learn how I can help you. You'll be happy that you did. Anyway, this has been another episode of 3 for Thursday. I hope you found it valuable and informative. Thanks for tuning in, and we'll see you next time.